PayPal stock got absolutely slaughtered over the last 2 years. From its peak of more than $300 a share in mid-2021, the stock is now down more than 80% and hovering around the $60 a share mark. Over the same time period, the business has actually developed quite favorably, at least measured by the development of revenue. Although to be fair, revenue growth has slowed considerably. So have we now finally reached a point where PayPal's valuation seems to make sense again and may offer an attractive investment opportunity? In this video, we'll try to answer that question by looking at two different valuation methods, and we'll try to figure out what is actually needed for PayPal stock to double. Alright, hi everyone, my name is René and I've once again prepared a little presentation that is going to walk us through this video. So how could PayPal stock double? Let me just show you the table of contents of this video. So we'll first take a look at the long-term stock performance of PayPal's stock, but also PayPal's underlying business. We'll then take a look at the time frame that we will need to consider over which PayPal stock could theoretically double. We'll then take a look at the inputs that we will need for our first valuation approach and also partly for the second valuation approach. And then we'll get to the valuation part. And I think the second valuation approach that I will show you in today's video is actually particularly interesting. So please make sure to stick around. And then of course, I'll present my quick conclusion and would of course be interested in your thoughts on the topic at hand as well. So let's jump right into it and take a look at the first chapter of this video, the long-term performance of PayPal's stock. As we can see here, over the long term, PayPal stock has actually underperformed the broad benchmark index, in this case, the S&P 500. But what we can also see here is that actually until 2022, PayPal stock was outperforming the market. And actually, depending on which time period you take a closer look at, PayPal stock was outperforming the market by a relatively wide margin. But over the last 2 years, as I said in the introduction of the video, PayPal stock basically got murdered. The stock is down more than 81% as of today. And yeah, obviously such a steep decline makes it very hard for any stock to keep outperforming the broader stock market. So to be a little more precise, over this pretty much 8-year time period, PayPal stock has compounded at a compounded annual growth rate of 7.1%, while the overall market has compounded at a rate of 11.8%. So basically PayPal stock is almost lagging the market by a compounded annual return of 5% annually, which is pretty significant if you do the math. And yeah, we can actually zoom in at the total stock performance or index performance in case of the S&P 500 over this 8-year time period, and we can see that PayPal investors enjoyed a total return. I should say that this is only the price return, but still a total return of 75%. And S&P 500 investors actually enjoyed a return of pretty much 150%. All right, what actually caused the rather steep decline of PayPal's stock? I think there are a couple of reasons. First of all, the bull market came to an end, like the longest bull market we've ever seen, basically. The bubble of 2021 also burst. There was lots of speculation in the market. And of course, PayPal, as one of the digital or mainly digital businesses, was one of the main benefits of COVID. Management made lots of promises and the business simply couldn't keep up with those promises. And the valuation to some extent also just came down back to earth. And with many of the investors now acting more rationally, many of the negative developments at PayPal receive more emphasis. Like for example, the capital allocation over the last couple of years. As I pointed out in some of my other videos, PayPal has a rather poor capital allocation track record over the last few years. This is not including the acquisitions of 2013, where they bought Braintree for around $800 million, if I remember correctly. But in more recent years, as I said, there were also the rumors of Pinterest acquisition of, I think, $45 billion. Well, more recently, management seems to be, or apparently wasn't as disciplined as in the past and was arguably destroying shareholder value. Then, of course, if you've taken a look at PayPal, you will be very aware of the increased competition in the online payment processing space, which of course has also to some extent led to a depression of margins. Now, interesting, if we now compare the performance of PayPal's stock to the performance of PayPal's business over the same 8-year time period, we can actually see that revenue is up 4x and operating income too is up 4x, which is pretty significant. I would have to do the math on the compounded annual growth rate, but 4xing both revenue and operating profit is quite a remarkable result for any stock, I would argue. And now if we see such a discrepancy between the stock price performance and the performance or development of the underlying business, this is actually always, or I should say almost always, an interesting setup. But there is a big but in the case of PayPal, because if we take a look at the valuation of PayPal stock over the last 8 years, we can see that PayPal's valuation was actually never particularly cheap and arguably very rich. So for example, the enterprise value to sales, so revenue multiple, over the last 8 years was at some point as high as 14x, and the mean is still at 7.62x. And considering that the free cash flow margins of PayPal stock, excluding stock-based compensation, is actually not that impressive, not that high. It's somewhere in the 15% range. This is quite an elevated valuation, in my opinion, and it only made sense for the valuation to come down. Yeah, and this is maybe even better reflected if we take a look at the enterprise value to operating income multiple. What we can see here is that over the last 8 years, the mean of this multiple was basically 50 times PayPal's operating income, which is very significant and a very rich valuation, at least measured by my standards. A quick correction, I just said over the last 8 years. I think both charts here only show the last 5 years of PayPal's valuation. Alright, this brings us to the next chapter of this video, over which time frame do we want to determine if PayPal stock could double. Should we go for 10 years, which is maybe a standard time period to measure the performance of a stock? Well, I would say if we want the stock to double, this is not the right time period to look at, because as we can figure out if we use the rule of 72, which is basically a rule of thumb to figure out how long it will take a stock to double, considering a specific rate of return. Well, if PayPal stock would double over the next 10 years, this would only translate to a compounded annual return of 7.2%. And while many of you may be satisfied with that, that's not the rate of return that I'm aiming for. So we need to take a look at another time period. So what about 5 years? Well, if PayPal stock can double over the next 5 years, this will translate to a compounded return of 15%, which is much more in the ballpark of what I'm aiming for. And yeah, I'm actually aiming for a little lower rate of return, but if I'm demanding 15%, this will already give me a little margin of safety in terms of the price that I'm willing to pay. Yeah, and this will then obviously bring us to the inputs of our valuation models. Well, what do we have here? First of all, in my first valuation model, I was looking at PayPal's revenue, which over the last 12 months was 28.5 billion. Then the next input is revenue growth, because obviously to determine whether a stock is attractively valued, you pretty much always have to consider the development of growth, profit growth, or revenue growth as well. And I was just taking a look at the estimates of analysts, and over the next couple of years, analysts are basically expecting revenue growth of around 10%. So this is what I used for my first attempt here. Then to value any business, you have to look at the actual cash flow generated by that business. So what kind of free cash flow margin, so that's basically how much of total revenue will then be translated into actual free cash flow. Free cash flow basically means the cash available to the owners of the business after having spent all the money that is needed to maintain the business in its current form and its competitive position. Well, the free cash flow margin of PayPal that I assumed in this model here is 15%. How did I arrive at this number? Well, basically the free cash flow margin of PayPal over the last couple of years was 18 to 20%, excluding stock-based compensation. However, if we do include stock-based compensation, we are more in the area of 13 to 15%. And this is also similar to PayPal's operating income margin, which was over the last couple of years hovering around 14 to 17%. Then what we are doing next is basically we are comparing PayPal's valuation today to a possible valuation in 5 years to determine a valuation, or a price I should say, that PayPal may be trading at in 5 years. We need to consider at how many times its free cash flow PayPal will generate in 5 years, it will trade at in 5 years. I hope that makes any sense. And I actually think PayPal could be an above average business. The business model is super attractive. Personally, I'm not so sure about the competitive position of PayPal and generally how the competitive landscape will develop. If we assume, however, that PayPal is an above average business, multiple of 15 is actually fairly conservative, but generally speaking, I really like to use very conservative inputs in my valuation models. And finally, as I just said, we need to factor in the current price, which is around 70 billion. Obviously, PayPal's stock price will move around on a daily basis, but basically right now PayPal is available if you would buy the entire business for around 70 billion US dollars. So if we take all of this into consideration and put it into our valuation model, well then the market cap of PayPal in 5 years, so in 2028, will be 103 billion US dollars. And if we now calculate the compounded growth needed to get from 70 billion US dollars to a market capitalization of 103 billion US dollars, as you can see, this translates into an expected annual return of 8%, which, as we have shown, is not enough for the stock to double. And we can see it here as well. We need to arrive at a market capitalization of 140 billion. So let's play around with the numbers again and let's try again. So obviously you can play around with different inputs. The two I was playing around with here were, first of all, revenue growth. So I was increasing the expected revenue growth just a little bit, and I was increasing the future free cash flow multiple. I think it's actually reasonable to assume that if PayPal can keep its position in its current form at least, that the business will at some point trade at a multiple of 20 times its free cash flow. And if we make these two changes, as you can see, we arrive at a market capitalization of $151 billion in 2028, which will translate into the needed return for the business to double. Okay, just real quick, if you want to learn how to invest successfully and how to finally stick to a proven system that has clear processes in place, feel free to reach out to me. I'll put a link to my mentoring offer in the description box down below. I'm looking forward to hearing from you. So just to be clear though, if you want a return of 15%, you haven't really implemented a margin of safety yet based on these inputs. So put differently, if you want a rate of return of 15%, personally, I would not be willing to pay the current price yet because there is no, as I just said, no margin of safety in case one of my inputs is simply wrong. And maybe another takeaway here is valuation is super difficult. And basically we're just playing around a little bit with the numbers here, and the impact on the overall return was very significant. We almost, or I would have to check, but I think we pretty much doubled the compounded annual return over this fairly short time period. So over shorter time periods, playing around with the numbers can be, I would say, in a way dangerous because it can have a tremendous impact on the overall business valuation. And there is the risk that if you do work with the model yourself, that you're basically just trying to make the numbers work for you in a way you're trying to justify paying the current price. But you always have to be very careful and make sure that you remain conservative. Don't try to make the model say what you wanted to say. All right, here's another valuation approach, my second attempt. So if you are familiar with PayPal's business, you should be aware of the fact that capital allocation has transitioned a little bit and shifted the focus from acquisitions to buybacks. In more recent years, PayPal has actually fairly aggressively bought back its own stock. And you can see this in the chart that I will show on screen here right now. Basically, you can see that in 2022, PayPal spent 4.5 billion US dollars on share repurchases. They basically spent a similar amount in 2021 and a little less in the previous years. And was basically comparing the cash spent on share repurchases to the operating cash flow generated by PayPal. And as you can see, I would have to do the math, but we're probably in the range of like 80% of PayPal's operating cash flow. So most of the cash flow generated by the business in the last 2 years was used to buy back PayPal's own stock. And this is actually something that we can expect going forward as well. I found this excerpt from Gabrielle Rabinovich, who's the acting chief financial officer at PayPal right now. And here's what she said. I've highlighted the most important parts, but let me just read a couple of excerpts to you. So as you have seen over the past few years, we have meaningfully shifted our capital allocation, and we've been more aggressive on the share repurchase side and have done a lot less from the standpoint of being acquisitive. That's basically what I just said. Then later she says, we indicated that for this year, meaning 2023, we'd expect to return 100% of our free cash flow in the form of share repurchase. We continue to believe that our intrinsic value is much greater than how we are valued by the market today, and so we think share repurchases is an appropriate area for us. So, and if we want to consider this focused on share buybacks, I think it's actually better to use another valuation approach. I'll just refer to it as basically a total return analysis. What you can see on screen right now is the formula for the total return that the stock will deliver to shareholders. It's made up of 4 different components. We've got earnings growth, changes in the valuation multiple, and then of course the impact of share buybacks. And if a company is paying out a dividend, this will play a role as well. So if we focus on the first component of this formula for now, earnings growth, I just assumed a compounded growth of 11.2% over a 5-year period once again, which will basically increase PayPal's operating income from 4.7 billion to 8 billion in 2028. And this basically reflects an increase by a factor of 1.7x. Then next up, changes in valuation multiple. This is something that we have done in the first valuation approach too. In this model here, I assumed once again an increase of the valuation multiple from 15 times operating income, that's basically PayPal's current valuation multiple, to 18 times, which again reflects an increase of the multiple by a factor of 1.2x. And then finally, we've got the impact of buybacks, what we've just discussed. And this is maybe a little more complex, so let me just walk you through some of the considerations that I've looked at or taken into account for my valuation approach here. So what I've considered is that over the last 4 years, stock-based compensation, which is diluting shareholders, was around $1.2 billion per year. At the same time, the average money spent on share repurchases over the last 4 years was around $3.3 billion. And if you combine these two, so obviously stock-based compensation will increase the shares outstanding, while share repurchases will decrease the number of shares outstanding. Well then, if we just take a look at how the total number of shares outstanding developed over the more recent years at PayPal, we can see that basically the share count declined by a rate of 2%. And this is what I also assumed in this model. If the share count over the next 5 years will continue to decrease at a rate of 2% a year, there will be 1.03 billion shares outstanding in 2028. And again, this represents an increase by a factor of 1.1x. If we now combine all of these sources of the total return, we arrive at a total return of 2.25x, which translates into a compounded annual return of 17.6. And once again, if all of these assumptions come true, then PayPal stock will double. But of course, there is a big if. I cannot guarantee you that these things will happen. But then again, I don't think you have to come up with stretched expectations and assumptions to make PayPal's valuation make sense here. But just to be clear, I'm not a PayPal shareholder. I don't have the conviction in the stock and in the business that all of these assumptions will come true. But as I just said, I don't think these assumptions are completely unreasonable. Which brings us to my conclusion. Basically, I have just articulated it. What I would say is I believe in the PayPal brand, and I don't think PayPal will go away. They actually deliver a lot of value to merchants. Customers are more likely to transact if the PayPal transaction option is available. So I think the downside at PayPal's current valuation is actually fairly limited. However, due to increased competition and also the uncertainty regarding PayPal's new management, I lack the conviction regarding the upside of the business and thus in return the upside of the stock. Yeah, and with that, I'll wrap it up here. If you liked the video, please leave a like. A comment would also be much appreciated. I hope you have a great day.